When we're finished with 4 sessions here, hopefully each of us will have really progressed. I know I will. And I hope all of you do too. But I want to keep this interactive. It's very important that if I do something that you, or say something that you don't understand, I go too fast on something, stick your hand up and stop me and let's straighten it out, because this is cumulative. We're going to learn the terminology, or the language, if you will, of finance and Wall Street in particular. And then we're going to learn the tools, and we're going to put those tools to work to learn how to analyze the health and the future prospects of individual companies, and how then to appraise whether the shares trading in the marketplace are undervalued, fairly valued, or overvalued. And we'll try in future sessions to do the same for the overall stock market and for the credit markets, the bond market and other credit markets. So we're going to try to cover a lot of ground. I hope that those of you who are not likely to seek a career on Wall Street, but might well have a career with a non-financial business, will realize that what we're going to do here in these sessions will give you a basis in both the language and the tools to succeed in any non-financial business that you might go into. Since I have so little experience, I occasionally have to look at my notes. Okay, I think, again, to repeat, if something confuses you or troubles you, get your hand up right away. I'll start with an apology. My handwriting is terrible. And I probably ought to practice. I ought to stay here after class and practice writing on this board. We'll talk for just a moment about the various types of business entities there are. There are sole proprietorships. If you set up a lemonade stand out front here and you're the sole owner of the business, that's a sole proprietorship. There are partnerships where more than one come together, and together they own and operate a business. There's a drawback to a partnership, and that is unlimited liability. If you should run afoul of the laws and get sued and get a judgment against you, they can take all your assets. So very few businesses today are partnerships or limited partnerships. What we do, we have LLPs, limited liability partnerships, and we also have LLCs, limited liability corporations. I happen to be a director of a limited liability corporation. The reason we use that form is that the company I'm involved with is losing money. It's in a startup phase. So there's no point in letting the losses that we incur in the first several years of our business stay with the company. The limited liability corporation allows each of the owners of this company to get his share of each year's losses in proportion to the capital that he has invested in the business, and take those losses directly against his own personal tax return. And then we have what we're going to talk about in this set of sessions is a C corporation. That's what you typically know when you see companies traded on the New York Stock Exchange. These are shareholder-owned businesses where the profits and the losses belong strictly to the corporation. The only pass-through, if you will, would be if the corporation were earning money and it paid out some dividends to its owners. So the C Corp is the form most common, and we'll use that here. There are other forms we may get to later on because there's some interesting aspects to them. There are master limited partnerships, and there are real estate investment trusts. All of these are kind of a hybrid between the LLC and the C Corp, but we'll get to those in time. There are 3 documents that you need to understand in order to appraise a corporation. The first is the balance sheet, which I have crudely put up here behind me, and we're going to use this for a few minutes. That is a snapshot of the corporation's health on one given day. The balance sheet of a company whose business year ended on December 31st is the balance sheet that appears on December 31st on the company's books for that one day only. The second is the income statement, which gives you a look for a period of time, either a quarter, 3 months, or a whole fiscal year, 4 quarters, which tells you, it summarizes for you the achievements of the company during the year or the fiscal quarter in question. It will tell you what the revenues were, how much of whatever it is the company sold in dollars, and it will itemize the various expenses that were incurred in order to support those revenues. And hopefully at the bottom line, there's a positive number called profit. And that profit you can also think about as the value added that that company achieved as it made something, sold it to customers, took the expenses of it, and the profit that was left was the value added for that company. Now, I hesitate to do what I'm about to do, but I think if you'll forgive me for the silliest little example you've ever seen, it will quickly get you familiar with a balance sheet. And then I'm going to put a more complex one up on the screen. So we have on a balance sheet assets on the left-hand side, and the assets are all the things the company owns. We would have cash. We would have what we call accounts receivable. That's the money the customers owe for things they've bought from this company and they haven't yet paid for it. Companies typically give customers some period of time. Even Bloomingdale's gives you a month to pay your bill. The next thing would be inventories. The goods the company has that it plans to sell or hopes to sell. And those inventories might be in the form of raw materials, work in process that hasn't yet been turned into finished goods, and finally, finished goods themselves. There are other categories, but we needn't get into them at this point. The point is that those cash, receivables, and inventories are the three assets that the company has which turn over frequently, maybe every week, maybe every month, maybe every quarter, as they sell goods, get the money for those goods, reinvest that money to buy more inventory to turn into finished goods, and so on and so on. Now, in order, we're going to call those current assets. In order to produce something, you may need a factory, machines, and heaven knows what else. All kinds of stuff, whether it's in the factory or in the office, computers or anything else, and we'll call those fixed assets. Now, how does the company get the money to buy these assets? Let's have a lemonade stand. But before we do, let me make one other point. The liabilities are what the company owes at any point in time. They might include accounts payable, the money they owe their suppliers for having furnished them with inventory. There's wage and salary payable that accrue over a month and then paid out, and then the next month it starts again. There might be income taxes payable, and there might finally be loans payable. Those are the current liabilities. And finally, there's the equity. And that, the term equity is the same as stockholders' equity, common equity, shareholders' equity, capital. They're all synonymous. All right. So what I want to do here, if you'll bear with me, is I want to go outside and I want to start a lemonade stand. And I'm going to put $100 of my savings into this new business. And so $100 is going to appear on the balance sheet today as cash. And it's going to be down here as owner's equity. Now that's the first important thing we need to know, is that assets, what the business owns, equals liabilities plus equity. The liabilities and the equity support the assets. Now, I got a great idea. I got a great location out here at 68th and Lexington. I need to get into business. The first thing I'm going to have to do is invest in some fixed assets in order to produce lemonade and to sell it. I figured out I would need a table, a chair, a pitcher, a spoon to mix it with. I think that ought to do it. And I can probably buy all that for $50. So I'm going to have $50 worth of fixed assets here. But wait, 150 and only 100, I don't have any liabilities yet. This doesn't balance. So the reason is that if I spend $50 for those fixed assets, I now only have $50 of cash. I've preserved the identity of the balance sheet. Total assets, 50 plus 50. Total liabilities and equity, $100. All right, now I got to go one step further. I need some distilled water, some cups, some lemons, some sugar. Anybody else? Whatever. So I'm going to spend $25. So I'm going to have $25 of cash, and I'm going to have $25 of inventory. I've still preserved the identity of the balance sheet. Now, we're gonna, I have to take a fast forward here because I don't want to complicate this at this stage with the all the details of the income statement. We're going to get to it, I promise you. But right here, let me just say that let's say that I sell $20 worth of goods. So I would now have $45 in cash, but I have now less inventory. I sold the inventory, the lemons, the water, the cups, etc. So I only have, let's say, $10 of inventory left. And now we see that this balance sheet is $45, $55, $105. And if you allow me to fast forward, I would have now, to preserve it, I have $5 of profit that I made when I sold that lemonade. And so once again, the identity is preserved. $105 worth of assets and accumulated earnings, retained earnings, they're all the same. They now have augmented the equity to $105. All right, I'll fast forward a little bit more. I've decided that business is so good that I want to open another stand. I want to branch out. But I don't have enough money to do that because my original equity of $100 is really pretty well tied up in fixed assets and inventory. So I need a way to finance my expansion. Well, I could find another partner and let him or her come in and invest in the company. That's a possibility, but it won't help me with the example I'm trying to make. So I'm going to go another route. I'm going to go to the bank and I'm going to borrow another $100. So now the balance sheet is going to have liabilities of $100 plus my remaining equity. So I have $205 here, $145 in cash because I just got the money from the bank, and once again, I apologize for my handwriting, we have $205 in assets supported by $100 worth of debt and $105 worth of stockholders' equity, owner's equity, common equity. They all mean the same thing. Everybody with me on this? No. All right, I knew somebody would raise a hand, please.
So I wrote to after you borrow the 100. When you, okay, so you borrow the 100 from the bank.
Yep.
Now your equity goes up to 205, and that's why I lost you.
No.
Huh?
The total of the balance sheet went to 205, but the equity didn't.
The equity is 200 now, right?
I borrowed the money. See, I've got $100 of loans up here.
Got it. Yeah.
plus the equity I had before I decided to expand.
Okay.
We together on this one? Okay, very important. I jiggled this machine. Oh, wait a minute, I guess I have to pull this down. If you thought my handwriting was bad, you may find the print here a little smaller. Forget everything down here. Okay, these are footnotes that are of no importance to us right now. Here is Tesla. Everybody know what Tesla does these days?
Cars.
Great car, gotta love it. It's such a good car that the auto dealers of Texas, Arizona, and New Jersey, and maybe coming up in Ohio, have persuaded the state legislatures to ban the direct sale of automobiles out of a store, as Tesla sells them, right out of their store. You think the auto dealers are a little worried that maybe they've been overcharging you all these years? Maybe you could get a better deal if you just go to a Tesla store and buy one? Yes, ma'am.
I have a question. I remember in another class my professor.
I'm sorry?
I remember in another class my professor told us that the car dealers they actually have a union to make buyers unable to buy cars from online, and then they can have their job.
Oh yeah, I wouldn't call it a union. It's a trade association, and it's absolute protectionism. Everybody here know what Uber is? Uber? Call the cab on your cell phone? Great system. In Paris, France, the French, who are the most protectionist people I know, have made it a rule that when an Uber driver gets a call from somebody's cell phone, he has to wait 15 minutes before he can pick them up. Who are we protecting there? The old-fashioned cabbies. It's exactly what's happening with the auto dealers.
So how come you're saying that for the Tesla, they're not allowing the dealers to sell directly?
No, the dealers are trying to prevent Tesla from selling direct. There is in Chelsea, in the Art District, on about 25th Street, 24th Street, I can't remember, far on the west side between 10th and 11th Avenue, there's a Tesla showroom. And you can just walk in there with your checkbook and drive out with the car. Anyway, I don't want to teach corporate morality. I'm just trying to teach an investment analysis. Excuse me. Yeah, can you see this from where you are back there?
Isn't there a way to get it closer?
Well,
Yeah, there's like a.
first of all, I wrote it at the top that asset.
The knob, it might be able to adjust.
Here, I'll try it. I think we tried earlier, but it
Sandra, you
doesn't
want to try it again?
Yeah.
If you move it back, it'll get bigger too.
Oh.
That's quite fluffy. Yeah.
I'm going to.
Perfect.
Yeah.
Focus it.
That's about the best we can do. I will leave these with Sandra and
I
let
can
her make
distribute
copies
copies
of
if
it.
you guys want.
Because we'll use this slide and the next one quite a bit in the next few weeks. But you can see up here, sorry, this is all I got to point with. You can see cash, accounts receivable, and inventories. Again, then you have property and equipment. Forget the miscellaneous assets. They total on December 31st of this year, $2,416 million. That's the total assets of this company at that one date. We have, on the liability side, accounts payable, various deferred revenue items, liabilities, leases, long-term debt, and we have the stockholders' equity. So the company has liabilities of 1.7 billion, stockholders' equity of round numbers 700 million, and the total is 2,416,930, exactly the same as the assets. And when you're keeping the books on a company, that identity is always going to be constant. Assets must equal liabilities plus equity, or otherwise stated, the assets the company owns are paid for either with borrowings or the capital of the owners. Okay, so there we have the balance sheet. Now, this is going to be very important as we get a little further along, because when we combine the balance sheet with the income statement, and I'm going to put one up in a minute, and the cash flow statement, that's going to tell us how successful the company is. And by success, I mean how profitable is it. I'll be the first to tell you that a corporation has at least 5 stakeholders. It has its owners, it has its employees, it has its customers, it has its vendors, the companies that supply them with whatever they need to make whatever they make, and it has the community at large. Keep the pollution down, for starters. Contribute to the community in one way or another. I have a grandson. He plays on the baseball team, the Johnson Auto Parts team, okay? All over the sweatshirts. So there's an example of a company giving back to the community. You've seen it. You saw it with the Olympics. How many corporations have contributed out of their profits to support community causes? So you have 5 principal stakeholders. Not to ignore them, but to stay on the focus of these sessions, we're going to only focus on the stockholder. Okay. Now, the income statement, as I said earlier, I hope, will tell you how successful the company is at making a product and selling it and having a profit left after expenses. Whereas the balance sheet here is only one day, the income statement will cover a period of time. In Wall Street corporations, publicly traded corporations, the income statement will cover typically 1 3-month period. Most corporations have their quarters, their so-called fiscal quarters, ending on March 31st, June 30th, September 30th, and December 31st. But there are some businesses for which that periodicity doesn't make sense, so they will have a slightly different fiscal year. Retailers, department stores, typically have their fiscal year ending on January 31st, because they go through the Christmas season, and then in January they clean out the inventory that didn't sell, and so it's a truer test of the profitability or the success of that retailer to count all the beans at the end of January. And there are other companies that have other fiscals for some good business reason, but it doesn't make any difference. So if I can remember to put this on the right way, which will be an achievement. Let's see how this is. First time. Okay. So what we see here is, I thought everybody would be interested in Tesla because I think it's a hot new product. And unlike Facebook, they actually manufacture something. So I chose this one. I want you to ignore this middle column. It's unusual for companies to do it this way. So I want you to ignore that column. So what we're going to look at here are the revenues and the expenses and the earnings for the 3-month period ended December 31 of 13, and we're going to compare it to the 3 months a year earlier, December 31st of 2012. And then over here, we're looking at the whole year for this company. The whole fiscal year, calendar year in this case, revenues, expenses, and earnings. Now, when we start to talk about the achievements of the company, we have some Wall Street language, and I regret that it's not showing very well here, but Sandra, if you'll distribute these, will be much better, and I'll have a handout next time. Let me just see where I am here. When we're looking at a company to see whether we're interested in it or not, the first thing we will look at is how big is the addressable market. The addressable market for smartphones, we now know, is in the several billion. And then we'll look at how much more growth potential there is in that market. In the case of Tesla, we don't know how big the potential market is for this company yet, because in the United States, about 15 million automobiles are sold each year. Tesla is ramping production to where it can sell 1,000 cars per week. That's 52,000 cars in a year. That is an infinitesimal market share. Now, Teslas are expensive, so the guy who's buying a Honda Civic is not in the market to buy a Tesla S sedan yet. So we just don't know what will be the ultimate penetration of the American automobile market. Yes, please.
Don't we know that it's going from gas to more electronic, right? Isn't it charging through?
Well, I mean, there's clearly a shift in preference from the gasoline engine to an electric car.
So it depends on which states have implemented not a gas station but the electronic station.
Oh, Tesla is financing the building of charging stations all over the country. So the capability will be there. Yes, please.
How do you measure market share? How would you judge that?
Okay, I'll tell you exactly. You take the size of the market at any point in time, any year, let's say, and you take the unit sales, not necessarily the dollar sales, the units sold by whatever company it is, in this case Tesla, and divide that. So in the case of Tesla, for this calendar year, you would take 52,000 cars and divide it by 15 million total cars sold, and you get an infinitesimal market share. Yes, please.
Earlier, did you say that the growth potential you don't really know for Tesla?
I'm sorry?
Did you say like 5 minutes ago that you don't really know the growth potential for Tesla in particular?
I don't yet.
Why wouldn't you though? If you know that there are maybe X number of luxury cars which are sold in the United States per year on average, and you know that market, the addressable market, then wouldn't that tell you the growth potential?
Well, you've raised 2 points, and following yours. Let's say that out of 15 million cars sold in America this year, and by the way, we're leaving out all foreign sales. These cars are sold abroad as well. Let's say it's 15 million. And as you point out, let's say, and I don't really know the number, the luxury car market is 1 million units. Jaguars and Bentleys and Rollses and BMWs and all that stuff. That's Tesla's market segment. You're absolutely right. I said before that they were selling 50,000 cars in a year. So 50,000 Teslas divided by a luxury market of 1 million, they have a 5% share of the luxury market. But I don't know how much, this car's just been on the market 2 years. I don't know how high this can go. I don't know how to project that.
Can I add to that?
Yeah, please.
So the hardest question for any investor or entrepreneur is, what is your definition of addressable market? That's the hardest question, because if you're coming up with a brand new product, like a spaceship, for example, how would you define the addressable market? And that's a very common question in interviews. They'll throw out like, oh, if there was such and such, imaginary product, how would you come up with an equation for estimating the addressable market? And it's for something like cars, there are lots of existing numbers you can pull from. For something like a spaceship, you'd have to come up with a proxy. So you could say,
to bring back space reduction from America.
Exactly. But so interviewers will want to know, how do you tackle a question like this that doesn't have tangible numbers? That's why this is a very important concept.
Can I erase this for a minute? Everybody got all you're going to get out of that? Sandra, you're in the wrong seat. You belong up here. I can't tell you how far Tesla can go in terms of market penetration. I think it's going to be a lot higher than 5%, but I just don't know. But here's a model. Let me shut this off first. This is what we call an S-curve. Here's a new product is introduced. This is years on this axis. Again, sorry about the handwriting. This is years, and this is units sold. Units. Boy, that's awful. And a typical S-curve looks like this. There's the typical life cycle of a product. Now, here, in essentially a 45-degree line, is the penetration or market saturation of that product. refrigerators, washing machines, dryers, stoves, household appliances. Every one of them looks like that. Television sets. Except we got fooled with television sets. People have more than one. So that one's a little trickier. Now, I'm way ahead of where I want to be. This is about 2 sessions down the road. But I will tell you that this same line of sales equals the same line for production, assuming all the inventory gets manufactured and moved out the door. If you're investing in this company, this line will start to peak out long before the penetration line peaks out. And when this line starts to peak out, say about there, you reach for the phone, call your broker, and sell the stock, because the party is over as far as Wall Street is concerned. Critical. So you've opened up Pandora's box here, and maybe before we're finished we can figure out how far Tesla's going to go. But I can promise you, the first time Elon Musk, the entrepreneur who started this company, comes before Wall Street at a quarterly conference call and says, production next quarter will be flat, stock will drop like a stone. People will say, that's it. The market can only take so many of these units per month, per week, per year, per quarter, whatever it is. And they'll say, the party is over. Get out. No matter how statistically cheap the stock looks, and we haven't even gotten into stock valuation yet, so let's hold that thought. I really want to see if we can get this right. Okay. The most important stuff on this chart are these little calculations that I've made for beginning to gauge A, how well they're doing, and B, how well they're going to do in the future, in the relatively immediate future, with respect to making profit. Again, 5 stakeholders. Here we're only concerned with stockholders. So what we see here is that in the 4th quarter of last year, the December quarter of 2013, sales were 107.5% above the 4th quarter a year ago. I just took the numbers up there, punched them out on my calculator, and got those numbers. I promise all of you that if you got through the 4th grade, where in my year division was taught in the 4th grade, multiplication in the 3rd, that'd be as much mathematics as you're going to need in these sessions. In the 4th quarter a year ago, the gross margin of this company was 5.3%. In the 4th quarter of 2013, the gross margin was 25.7%. Now, what is the gross margin? If you only had one number that you had to rely on for a total analysis of a company, it would be the gross margin. The gross margin is equal to the revenues minus the cost of producing whatever it is that you sold. It's called the cost of goods sold. There's labor, there's materials, there's what we call factory overhead. We'll get to that. It's just an allocation of the cost of the factory when they built it. Those are the essential elements of cost of goods sold. So revenues minus cost of goods sold equals gross margin dollars. Gross margin dollars divided by revenue dollars is the gross margin in percentage terms. I want to be sure everybody's with me on that one.
Could you repeat?
Yes, sure. Revenues minus what we call CGS, cost of goods sold, is the gross margin in dollar terms. You'll see it when Sandra gives you copies of this, because it's very clear up there. So you take that gross margin in dollar terms and divide it by the revenues themselves. What percent of revenues became gross profit? Does that help?
Thank you.
Okay. Now we're going one step further. You'll notice that this company was a whale of a lot more profitable in the fourth quarter of 2013 than it was in the fourth quarter of 2012. That's not surprising. You see that the volume more than doubled. The revenues more than doubled, 107%. Now comes the single most important ratio in all of financial analysis. God knows there's a lot of them, and I hope you'll learn a lot of them, but this is the single most important ratio, by far. This one will take a little thinking. This is called the incremental gross margin. And that is calculated as follows. You take the dollar change in gross margin, whatever the dollar gross margin was a year ago, and subtract it from the dollar of gross margin in this year's fourth quarter, and you get an increase in the dollars of gross margin. You take the dollars of revenue a year ago and subtract them from the dollars of revenue this year, and you get the increase in revenues, in dollars. Now you have the increase in gross margin dollars, and you divide it by the increase in revenue dollars. Everybody with me?
Can you repeat that again? I'm sorry.
You're going to take the increase in revenues in dollars from one year to the next, and you're going to take the increase in gross margin, or gross profit if you prefer, from one year to the next, and you're going to divide the dollar increase of gross profit by the dollar increase in revenues. So while the overall gross margin for Tesla was 25.7% in the fourth quarter on a total company basis, the incremental sales, the increase over a year ago, produced 44.7% in gross margin profit. The overhead is getting spread over more units. As they produce more units, the costs come down. We'll get to that later. So the increase in sales the dollar increase in sales was far more profitable than the total sales were. This profits, as Larry Kudlow, I don't know if you know who he is, used to say, the mother's milk of stock values. I will tell you that incremental gross margin is the mother's milk of profitability. When we're looking at a company to invest for our clients, we want to see on a quarter after quarter basis, we want to see this incremental gross margin higher than the total company gross margin, because that tells you that there's room for expansion still in the overall profitability of the business. Yes, sir, go ahead.
Does this tell you how much more effective your money is becoming? Or the firm's money is becoming?
I don't know that it tells you that. If you're talking about the investor's money, well,
The company's money.
well, look, it tells you that the profitability of the enterprise is still rising faster than sales. So it tells you if when you get the incremental margin above the company-wide gross margin, it's telling you that profits are expanding far more rapidly than revenues. And I can tell you right now that that's what Wall Street looks for. Because once we get out a lot of quarters from now, I don't know when it'll be, and the incremental gross margin starts to decay, as I call it, and it starts getting closer to the total company gross margin, then the leverage is out. And if company profits are only going to grow at the same pace as company revenues, then the valuation of that stock is going to be less than now when profits are growing far more rapidly than revenues. I hope you're all with me here because this is so critical. And we'll come back to it. Yes, sir, please.
So you'd argue that this is only possible for a company where there is a possibility for cost cutting, right? Because when you run out of room, then your profitability can increase any faster than the sales.
Well, now you've raised another very important point. Very important. There's two ways that company profits can increase. One is if they become more efficient, if they can cut their costs. That's absolutely true. And the other is if they are still increasing their revenues, hopefully at a fairly rapid rate. Wall Street investors will pay less for profits that are achieved from cost cutting, because that's essentially a one-time effort. Premium valuations, and we'll get to all that, but not today, will accrue to companies where the revenues are increasing rapidly, where this incremental gross margin is showing us that we have what we call leverage on the revenues. Now, yeah.
One side is telling us of demand, the other side is telling us supply. Is that what you're saying?
No, not really. No, don't think of this in macroeconomic or even economic terms. we're just looking at this business, whatever it sells, and we see that they're selling a hell of a lot more than they did a year ago. And we see that the costs didn't rise anywhere near as rapidly as the sales did. So the profitability, the gross margin, expanded. Now let me go a little further. In order to run the business, you have to have support systems. You can't just grind out these cars, push them out on the street, and hope somebody comes along with a checkbook. You have to have other corporate expenses. You have to have what we call SG&A, selling, general, and administrative expenses. Salesman's commissions, office overhead, all kinds of miscellaneous expenses apart from the cost of manufacturing the car. Somebody back home in the home office has to count the beans, find out how much money you made. Got to pay his salary. Got to pay the salesman, etc., etc. So one other way we look at corporate efficiency is to see what the ratio is between the dollars of SG&A compared to the dollars of revenues. And we divide SG&A, and it's up there on the sheet, by revenues. And we see that in this quarter, the SG&A was 16.5% of revenues, and a year ago it was only 15%. Now I can't tell you why it rose in that particular quarter. I just don't know. I know if I called up somebody at Tesla, they'd tell me. But I suspect it has to do with the fact that they are putting on more salesmen and other support people at a rapid rate because the business is growing at a rapid rate. So in this particular calendar quarter, that expense ratio went up. But look what happens on a year-over-year basis. In 2012, SG&A was 36% plus of sales. And now, in all of 2013, it was down to 14% plus. So you can see that by and large, on a one-year basis, the support costs, the SG&A, did not expand anywhere near as rapidly as revenues did. That's a source of profit leverage. All right? Now, this company is dependent upon developing new technologies, particularly battery technologies, designing new cars. There's lots more models coming out soon. So we have research and development expenditures, R&D. And you'll see that in the fourth quarter, research and development expenses were 11% of sales. For every dollar of sales that came in, 11 cents went to research and development. In the case of SG&A, for every dollar of sales that came in, 16.5 cents went to SG&A. Okay? Anyway, now, you'll notice that a year ago it was 22.5%. Well, 11.1 and 22.5, that ratio is about cut in half, right? Well, sure, because the sales doubled. So the R&D roughly stayed the same. They're spending enough in their laboratories to refresh the product, improve the battery technology, et cetera, et cetera, et cetera. On a year-over-year basis, R&D was 66% of revenues in all of 2012, but because sales were up 518% for the full year 13 over the full year 12, R&D was 11.5% of sales. So you can see that they've pretty well flattened out the amount of money they're spending on research and development. Yes, sir?
As far as R&D, isn't part of R&D capitalized for companies like this, sir? Or will it all
No.
be expense?
No, I think it's all expensed.
Okay.
Let's put it this way. I'd have to take another look at the balance sheet, but I doubt it. I think it's all expensed. Somebody else had a hand up. Yeah.
Would the R&D be listed as an expense line in the income statement? Or?
Yes. It's there.
Okay. I'm just trying to see if it's listed or you would just, oh yeah, R&D.
You see it? See it up there?
Under operating expenses.
Under cost of revenues, you have sales. Where are we here?
Yeah, and under operating expenses, you have R&D and then you have selling.
Yeah, there it is, R&D, right. Yeah. So it is expensed as incurred.
Okay.
Did I miss somebody? Okay.
Actually, we have one question.
Oh, I'm so sorry, I forgive my back.
I was just wondering when it was at 22.5%, because I'm confused now with the time.
Where,
I mean, I see that for R&D, I see that in 2012 it was 66.3%. I'm wondering when it was at 22.5%, because then it was
Oh.
going up from there.
that was in the fourth quarter of 2012.
Okay.
By that time, sales had ramped up a bit, so even if R&D were roughly flat, the ratio comes down quickly. So these are the essential measures of how well the company is doing. Now, I don't want to go any further because while I took Tesla, because I thought you might all be interested since it's an exciting new technology and a new product, nobody has tripped me up yet. Anybody got a calculator here? You got a calculator? Do me a favor. Add 3 numbers for me. 25.7, 16.5, and 11.1. What have you got?
53.3.
No. No, you can't. Oh, wait. Oh, I'm sorry. You're right. I'm terribly sorry. Let's do it again. My mistake. I did get through 4th grade. Barely. Take 100. Take 100 and subtract 25.7. When you got that?
Yeah.
Now add 16.5 and 11.1. Now what have you got?
101.99.
101, somebody's got 101 something?
0.9.
Call it 102. So the cost, not the gross margin, but the reciprocal, if you will, the cost of producing those cars, plus the SG&A, plus the R&D, was more than 100% of the revenues. The company is still in a loss-making mode. I don't know if the first quarter statement will be up by the time we get to the 4th session here. Hopefully this time they'll be in black ink. I think there will be. But you can see this is still in a very early stage of ramping up.
Does everyone know the expression black ink, red ink? Yes?
Black and red? Oh,
Black Friday.
black is profitability, red ink is loss. Right.
Yeah, that's why Black Friday.
No, Black Friday is different. Well, I'm sorry, I'm terribly sorry, you're absolutely right. Black Friday, the Friday after Thanksgiving, is called Black Friday because that's when retailers typically make enough in the way of Christmas sales to turn profitable for the year as a whole. It's not quite that true anymore. They do make a little money in the other quarters, but you're absolutely right. Black Friday is when they start making the real money. Absolutely. Now, let's see where we are.
So when you see a company at this point, it's still in red, but you are expecting that it's going to turn in black. Is this the moment to invest in a company like that?
The short answer, did everybody hear the question? The question was, if you see a company that's still in a loss-making position, but it's looking very much like it's going to start turning profitable, is that the moment to invest? And the short answer to your question, again, you're a couple of sessions ahead of me here, but you're right on, is no, you're already too late. I guess I better digress for a minute. The stock market is what we call a discounting mechanism. It looks ahead and discounts or anticipates the future. And we're going to talk, perhaps we'll do some of it today, about what we call the leading indicators of an individual company's profit. I call them the power metrics. And the power metrics are those figures that investors look to in order to anticipate the future profitability of a given company. I'll give you a few very simple examples. If we're talking about a commodity that sells, a company, if we're talking about a company that sells commodities, oil, iron ore, copper, natural gas, just for starters, most any commodity, investors will watch the daily fluctuations and the overall trend of the prices of that commodity, because they can quickly gauge how much a change in the price of the commodity will impact the profits. If you have a copper company and it's selling X millions of pounds of copper per year, that number may go up a little bit over time, may go down a little. There's a little bit of cyclicality to it. But the change in the amount they sell, the pounds of copper that they sell, is not the driving force of the profitability. The driving force is the price they're getting for that pound of copper. And that's the power metric. And if you show me a copper company, all I would have to do is look up about how much in pounds or tons they sell in a given year, get an idea of how much their support costs are for SG&A, And then all I've got to do is multiply it out by the price of copper that I think they will achieve. And if the trend is going up, I might buy the stock. If the trend is flat to down, I certainly don't want to go near it. China is the world's largest consumer of copper. They import most of it. The Chinese economy has been growing very rapidly. It's now slowing down a bit. It's changing its mix of output. Less infrastructure building, more consumer goods. The amount of copper it needs is diminishing, at least in relative terms, and the price of copper has been going down lately, and the price of companies that produce and sell copper have been plummeting, the stock price. We could talk about, I had intended to make a whole list of these power metrics, but do it next session. I'll give you a different example. Boeing, the Boeing company, manufactures the airplanes you all fly on. The stock of Boeing, the stock price of Boeing, is not dependent very much on Boeing's current rate of shipments, sales, and profits. It's far more responsive to the rate of growth of Boeing's backlog of new orders. When Boeing introduces a new aircraft, in this case the so-called 787, which I doubt anybody here has flown on yet, the so-called Dreamliner, these things are, I think, about $100 million a piece. When they introduce it, and the major airlines of the world are placing orders with them because there's a long lead time. If you called up Boeing today and said, I'd like to buy one of those Dreamliners, they would say, get in line, the earliest shipment date we can make for you is 2020, okay? Because these things take a long time to make. So airlines place their orders early on. There are cancellation provisions, but they place the orders early on, so Boeing stock will do the best when there's an influx of new orders, and the backlog, therefore, of unfilled orders is rising. The stock will perform according to the backlog, not today's or tomorrow's realization of that backlog. That's already ancient history. So we'll get to all this in another session, but suffice it to say that you can't look at the current level of profitability to make a decision as to whether or not you're going to buy the stock. Yes, sir, down the back.
Is there a correlation between the incremental gross margins of most companies and where they are on the S-curve?
Where they are on the S-curve?
Yeah.
That's a very good question. I would guess so. I haven't, that'd be a subject for a great term paper or graduate thesis, if you're so inclined, because the data are available. That would be a terrific topic. My gut tells me yes.
Thank you.
But I've never tried to look at it that way. Yes, sir.
When you say that investors don't react to companies' current profitability, why does the stock market react to quarterly earning releases?
Say that again.
When you say that investors don't react to current profit of companies,
Right.
my question is, why do stock market react to quarterly earning releases?
Oh, well, again, you're a couple of sessions ahead, but as long as we're here, let's stay here. There's several answers to your question, several sets of conditions that might cause that. The first thing is that stock prices, the market, will react positively or negatively to surprises. If there's a big securities analyst community out there, the major companies are followed and analyzed by anywhere from half a dozen to 30 or 40 different securities analysts representing different investment banks and brokerage firms. They publish reports giving estimates of sales, margins, and profits, among other things. The companies themselves will typically give what we call forward guidance at the time of their quarterly earnings release and the conference call that comes at that same time. These numbers come out on the internet. I get them on my Bloomberg machine, and then a couple hours later, the management holds an interactive conference call, talks about these numbers, how they got there, talks about the future. So they'll give some earnings guidance. The companies typically lowball Wall Street. They want to underpromise and overachieve. So you have the work of the analysts out there, and you have the guidance given by the companies, and all the analysts know that the companies tend to lowball, because everybody is hoping that when next quarter's results are announced, there'll be a pleasant surprise. And if there is a pleasant surprise, people will quickly recalibrate their forward estimates for the quarters ahead and rush to buy the stock. If there is a negative surprise, if they miss the consensus for revenues, profits, then Katie bar the door. The stock's going to go down for a while. If they have a good excuse, all is forgiven in time. The winter weather all over this country, not just in Manhattan, has been brutal. It has clobbered lots of businesses, retailers, auto dealers, construction companies, and all manner of companies that supply and support those companies have all been negatively impacted by the bad weather. So there are going to be lots of companies, when they report their profits for the 3 months ended March 31st, that are going to miss their prior guidance, going to miss the estimates that the analysts had. Excuse me. Now, for the most part, the analysts have already looked out the window and seen the weather, so estimates have come down. Many companies have issued press releases saying, hey, we didn't know about this winter weather, and so they've adjusted. So a lot of the adjustment has already taken place. Once again, I guess if incremental margins are my most important ratio, I will tell you that the next most important thing to bear in mind, again, thinking about the market as a whole or individual stocks, is that the realization of the results of the revenue and profits for a given quarter or a given year, the realization, the actuality of those results is a lagging indicator. By the time those numbers are out, unless there's a huge surprise in one direction or another, up or down, the market has already figured it out, because the market has tracked the power metrics. And analysts, you know, they've all got their earnings models on the spreadsheet on the computer. All they got to do is tweak a few variables, hit the button, and out comes a new estimate. I don't know how to do that, by the way, but they do. I have all I can do to get my computer booted up in the morning, but I've survived this long without it. So, did I leave anybody confused on anything, please?
No, I'm not confused.
Well,
Just,
it's all right.
Okay. When is a good time to invest in a company when it's really cheap, like the stock prices?
Well, look, the short answer is buy low and sell high. Now, how we're going to gauge whether it's really cheap or not, I'm going to have to save for another session, but I promise you we'll cover it. But needless to say, you want to look at any individual company, and before you start rushing down to Bloomingdale's to spend the profits you haven't yet made, you want to ask yourself, how much can I lose if things don't go according to my expectations? You must look at the risk side first. I can't stress that enough. Let's just see. Let me deal with just one more topic today, and that is how a company makes its profit. Not what division it makes it. Tesla's a bad example because it's only got one division. But there are many companies that have multiple divisions selling different lines of products. If you look at the General Electric company, you will see locomotives, turbines to generate electricity, whole power plants, jet engines, medical diagnostic equipment, MRIs and CAT scan machines, and oil drilling, wind turbines. I know I've left a few things out. I guess they still make light bulbs too. So that's a multi-divisional company. It's important to know not just which division is doing well, making a lot of money, growing rapidly, and which aren't. And it's also interesting to know which geography is making the money. Are we making the money in North America, in the Middle East, in Latin America, in Europe, China, Asia in general, Russia? But while it's very important to know which divisions are doing well or poorly, and what the outlook is for those divisions, and what geographies are doing well or poorly, the more important thing that unifies all this is how they make their money. We talked earlier about commodity companies, the copper company example I used. A copper company makes its money if the price of copper goes up. And if the price of copper goes down for whatever the reason, lack of demand, of course, but for whatever the reason, the company is not going to make as much money and might even be in a loss-making position. So we have to look at how the company makes the money. The shaving business has changed a bit since I started to shave. But when I was roughly the age of you guys here, Gillette was the dominant factor in razors. And if you went in the drugstore or the supermarket, they would essentially give you the razor, and charge you only for the blades. That was the business model. Give them the razor, they'll keep coming back. When the blades wear out, they'll have to buy more and more blades. That's a perfectly good business model. The company that I'm involved in, which is a medical diagnostics company, we're going to charge the doctors, who will in turn be reimbursed by Medicare and private insurance companies. We're going to charge them on a per-click basis. We have a highly sophisticated algorithm for diagnosing a range of diseases. And if patients come in and the doc uses our equipment, every time he clicks our little box, he's going to pay us. It's exactly the same as EasyPass, which I'm sure you're all familiar with. You go through the Triborough Bridge or the tunnels. You know, hopefully you don't have to stop in the cash line. You go straight through, and when that transponder sees your EasyPass up in your windshield, it charges you automatically, and off you go. So that's another way companies make money. Another way is periodic upgrades.